Hey everyone, welcome back for another episode of The Remote Real Estate Investor. My name is Emil and today I'm joined by
Michael Albom.
And on this episode, we're going to be talking about adjusting your expectations as the market changes. So something that's probably on a lot of people's minds, and we want to address it on this episode. So let's hop into it. Michael,
Emil,
tell me, is this something that you get a lot in the academy? Like people come up to you and say, hey, a couple of years ago, I was shooting for an 8 to 10% cash on cash, and now it's just not really possible with how property values have gone up and rents are growing, but not as quickly.
Yes.
What do I do?
Yes, absolutely. I get the question regularly and the sentiment regularly. And my response is usually quite similar. And it's either you're looking in the wrong market. So what you're looking for exists, but just not where you're looking for it. You aren't looking hard enough. So maybe it exists in your market, but you're only looking at the MLS, and maybe you need to go off market or wholesalers or change the avenue in which you're looking for those properties. Or maybe you just need to adjust your expectations. Maybe what you're looking for doesn't exist. And so those are usually the three options and the three suggestions that I give to people to go try. And so I think it's absolutely, the market has changed. The conversations we were having a year ago, we're having different conversations now. And so you can't go, it's like when let's go to a sporting event and the rules have changed. You can't keep trying to play the same game because you're not going to do well. And so I think we absolutely have to adjust expectations for the current conditions. What are you seeing, man? Are you hearing similar sentiment in kind of the circles that you're running in?
Yeah. I mean, I'm a less active, more maintenance real estate investor currently. So I haven't been making offers or anything recently. But, I follow a lot of real estate guys on Twitter, including you. And it's either two things happen. You either just say, I'm done doing deals, or you adjust your expectation. And I think Michael Zuber talks about this a lot. Our old pal from One Rental at a Time. He says you have to stay active in your market to know what's going on in your market. Maybe 5 years ago, you were doing 10% cash on cash returns, but markets change. Maybe a good deal now is a 7% return, right? And it's about finding the good deals in your chosen market versus like just arbitrarily finding a number and scouring to find that.
Yeah, I totally agree. And I think it is like you and I and Michael Zuber, we talk about hyper local. Like real estate investing is hyper local. And so it's really tough if you're chatting with a friend that invests in Kansas City and they're like, oh, I can't find, I'm trying to make 8% cash on cash return and having a difficult time doing that. And then you're over there in Austin, Texas, like 8%, holy crap, I kill for 8%. I can't make 3% work. Right. So I think it's hyper local and you have to really understand your particular market.
Yeah.
And I know this, everyone asks like, what is the return? Like, what's the number? And everyone's, I think, a little bit gun shy, myself included, because it's not an evergreen type of situation. Like today we're recording this in end of February, 2022. So if you're listening to this in the future, you might think there's no way we're getting those kinds of returns. It could be either way better or way worse. But I think on average, like the number spread of 5 to 7% levered. So that means like your cash on cash with debt, I think is what is realistic for a lot of people in a lot of markets these days. And a year ago, 2 years ago, that was just not the case. Like you mentioned, 8 to 10% was totally doable in a lot of different markets. And again, this totally is dependent on the asset class and the neighborhood and the market. And so you might be listening to this even as we're recording this and say, no, there's no way I can't possibly do that. I'm in San Francisco, California. Okay, yeah, well, that might be true. So you're someone where the market takes a massive effect and impact on, and you can't make those numbers work. So again, take this with a total grain of salt, but just know that the number expectation, for me included, has totally shifted. Has totally shifted.
Yeah. So you mentioned you tell people you engineer the number, right? Or like there's different levers you can pull to get maybe one of the return metrics you're trying to aim for. Can you talk about that more?
Totally. Yeah. Because I'm a reformed engineer, I still like engineering stuff. And so, I've learned now that you can really engineer your return. And there are, just like you mentioned, a couple different levers to pull. So one is obviously purchase price. And so we don't often have a big impact on what the purchase price is because the seller does, and especially because of how competitive the market is. So we might not be able to affect that lever very much. But We might be able to if we're making all cash offers. And so if you're able to bring all cash to the table, you might be able to be more competitive, and therefore you might be able to pull that lever a little bit more than your average bear. The second lever you can pull, which you absolutely have, I would argue, more control over, is your down payment amount. And so if you're someone that's using an 80-20 mortgage, you're bringing 20% down, bank or lender is giving you 80%, you're going to have some expected cash on cash return and some expected cash flow based on your numbers and however you underwrite. Well, if you put down 25% or 30%, you might get not only a better interest rate, but now you're going to have a smaller mortgage amount, which is going to translate to a higher cash flow. Now, we talk about this all the time on the podcast that, in my opinion, I think you should be looking at both cash on cash return and monthly cash flow in terms of dollars. Because you can have instances where your cash flow is through the roof, but your cash on cash return as a metric, how hard your dollars are working for you, is like minuscule, right? I could show you how to buy $1,000 a month property, something that cash flowed $1,000 a month. But if you have to go spend $1 million to get it, it might not be worth your while. Right. And going the other way with it, I could show you how to buy a property that might yield you 50% cash on cash return. And people hear that are like, oh, duh, that would be amazing. But if it only cash flows 27 cents a month and someone sneezes at the property goes negative, like that might not be a good situation either.
Right.
So
right.
I think most investors want to find a balance of the two. They want a strong cash on cash return. They want their dollars working for them, but they also want to put dollars in their pocket. And so you just simply engineer that by your down payment amount. And a question that I always tell people to ask their lenders if they're using a mortgage is, hey, where are the interest rate threshold breaks? So if I'm putting 20% down, this is my interest rate. If I put down 25%, what does the interest rate do? If I put down 30%, what does the interest rate do? If I put down 35%, and go find out where those thresholds are, because you might see that there's a really big jump or a really big change in the interest rate. And depending on the loan amount, and again, depending on your particular deal, getting a lower interest rate, even if you have to put more down, might actually translate to a better cash on cash return. And that's kind of counterintuitive for most people, because I think a lot of us think, oh, the less we put down, the better our returns will be overall, which isn't necessarily the case. So I've seen tons of instances where actually putting down more cash will yield you both a higher cash flow, monthly cash flow number, so more dollars in your pocket, as well as a higher cash on cash return metric. So actually getting your dollars working harder for you because they're not fighting so much interest headwind.
That's a fantastic points you bring up. And one of them is that higher down payment you're bringing. That the other point of that, other benefit, I guess I would say of that is, let's say you think prices are higher, right? When I think if you're borrowing less, right? You're protecting your downside a little more as well. Depends on where you think we are. You could say, nope, I think prices are going to rise for the next 5-10 years, whatever. But if you're unsure, that is one way you can provide yourself with a margin of safety. It's a little bit less leverage.
Totally. Less leverage and more equity. Absolutely. Absolutely. Right. And so I think it's important, and we were talking a little bit before we hit record here, that in today's market, you might have to sacrifice on one metric or the other. I talked about looking at them in unison and trying to maximize both, but that's often not the case. They often tend to be competing against each other. And so, pick a number that you're okay with, and maybe you have to give a little bit up on the cash and cash return side. Maybe your dollars aren't working as hard for you, but you're more excited about the amount of dollars you're putting in your pocket.
Yep.
Or maybe your dollars are working harder for you and you're more excited about that, and you got to give up a little bit in terms of actual dollars going into your bank account. And so it's just being flexible, adjusting with the times, adjusting your expectations for where we are in the current market cycle, where interest rates are, and where prices are.
Yeah. Solid. So what do you think is the, let's take away market timing. What do you think is the evergreen takeaway here for just expectations around returns as things go up, down, sideways, all those?
Yeah. I think we just have to take into account all of the things. So all of the things, in my opinion, are purchase prices. What are prices doing? And what are owner occupants doing? Because 5-10 years ago, I think we saw much less demand from owner occupants. And the pandemic has really shifted that. So everyone is trying to buy homes, owner occupants and investors, which puts a lot of upward pressure on the market. So that's a change. So we can no longer as investors go in knowing that we're only competing with other investors and figure out the best way to engineer our offer so that we make the best return. Because now we're competing with people that are paying way less in interest because they're owner occupants. So we've got to change our strategy yet again. So what the Evergreen takeaway is figure out what levers you have in your back pocket to pull. And so if you can make an all cash offer, think about what that looks like and how that might affect your returns. If you can put more money down, think about what that looks like and how that affects returns. And then just run the numbers. And it shouldn't be an emotional decision. It should be a fact-based and number-based decision. And like, hey, how do I generate the best return for myself? And again, that could be heavy on the cash flow and light on the cash on cash. That could be heavy on the cash on cash, light on the cash flow, or you could be maximizing both. But I think you got to do whatever it takes to get the deal done, and in an acceptable, like with acceptable metrics, whatever that means for you. And so again, moving those three levers tends to be the best way that I've seen to get deals done in today's market. But also, I mean, think about alternative financing options. So like seller financing or private capital. Like these are other ways to give yourself an edge, a competitive edge. And so think about how those might be able to affect your returns as well.
I dig it. Good tips. I will leave with my evergreen tip being know your market, study your market. Like Michael Zuber says, we talked about earlier, know your market, right? Your market, your individual market will change. And it's about knowing what a good deal is in your market, not what a good deal, what you used to think was, right? So know your market, what is the average return, and try to beat that.
Yep. Adapt or die, right?
Yep, exactly.
Sweet.
All right.
Should we get out of here?
Yeah, let's wrap this one up. Thank you everybody for tuning in. Hope you found this episode useful. If you did, please leave us a review, a comment. We love all those. It strokes our ego and it helps us find new episode ideas for you guys. So with that, we will check you out in the next one. Happy investing.
Happy investing.